If you're an NRI and you're still using your old resident DMAT account in India, you are breaking Indian law right now. And the worst part? You won't even realize it until the day the money gets stuck. I'm talking about NRIs trying to move 50 lakhs abroad and watching their bank freeze the transfer. Funds locked up for months, repeated documentation requests, sometimes back taxes. All because of a DMAT account they forgot to update years ago. And the scariest part of all this? We have seen NRIs operate the same resident account for 5, 7 or even 10 years with absolutely zero consequences. Everything looks fine on the surface until one day it isn't. So in the next few minutes, you will know exactly what to fix, how to fix, and how to avoid the massive compliance mess that catches most NRIs off guard. I'll cover 3 parts: the standard conversion route, a loophole most NRIs don't even know about, completely legal but almost nobody uses it correctly, and the third option that only works if you're coming back to India soon. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC and one of India's top wealth management firm before launching my own startup. This is Finicky, where I simplify money the same way I practice it. Alright, let's start with the fundamental rule, because once you understand why this matters, the rest of the video clicks into place. Under FEMA, the moment you become a non-resident Indian, you are not permitted to hold or operate a regular resident savings account or a resident DMAT account. These accounts are specifically designed for people who are tax residents of India. The moment your residential status shifts to NRI, you step into a completely different regulatory bracket entirely. And again, here NRI doesn't mean only for Indian passport holders, it also applies to OCI card holders. Now, here's the thing nobody warns you about. The reason most NRIs ignore this is because nothing happens immediately. Transactions go through, investments grow, there's absolutely no warning sign, nothing flashing red. That's exactly why most people don't think twice about it. But the problem doesn't show up until you actually need your money. And this is where things actually go wrong. The moment you try to repatriate funds, whether it's profits from investments or the proceeds from settling assets, things change fast. Your bank, your broker, even the income tax department can start asking questions about how is this money earned and under what account status. If your account has been non-compliant the whole time, this is where the issues stack up. Delays, additional documentations, penalties, even back taxes. In some cases, deeper regular scrutiny. What looked like a harmless shortcut suddenly becomes a serious compliance headache. So, what are your options? You have 3 clear paths, and stay with me till the end because the third path is the one most people don't even realize is on the table. The first option is to open an NRO or NRE DMAT account and transfer your existing security. This is the most straightforward, most compliant path, and honestly, more NRIs should just do it instead of overthinking. As an NRI, you can open 2 types of DMAT accounts in India: an NRO DMAT account or an NRE DMAT. Let me explain the difference, because this trips up so many people. NRO stands for non-resident ordinary. This account is meant to hold income that originates inside India. So whether it is rent from your property, dividends, interest from FDs, or proceeds from selling investments you already held in India, it all goes here. Think of it as your India income account. The money in an NRO account can be repatriated abroad, but only up to $1 million per financial year and only after paying the applicable taxes. Plus, every transaction above a certain threshold is reported to the RBI. So, there's a clear compliance trail. Now, NRE stands for non-resident external. This one is designed to hold money you bring into India from abroad. Essentially, income you have earned outside the country and transferred back. Its biggest advantage is flexibility. NRE accounts are fully repatriable. That means you can move your money out of India anytime, no restrictions. And the interest you earn is completely tax-free in India. Very efficient from a tax perspective. Now, here's something most YouTube videos completely skip. And it's the layer that catches NRIs off guard the most. To trade in Indian secondary markets as an NRI, you need something called as PIS account or non-PIS account. Think of it as RBI tracking your trades. Your NRI Demat account has to be linked to a designated bank account and your broker handles the reporting. Without these Demat in place, your trades aren't being reported correctly to RBI. So when you open your NRO or NRE Demat, your broker will guide you through the application. It's one-time setup. I've made a detailed video on PIS and non-PIS account. I'll leave the link somewhere here and also in the description. And there's one detail here that almost no one talks about. If you hold both repatriable shares, meaning shares originally bought with foreign funds, and non-repatriable shares like the ones you originally bought as a resident, RBI actually requires you to maintain two separate Demat accounts. One NRI Demat for the repatriable category and one NRO Demat for the non-repatriable category. You actually cannot mix the two. So this is less of an either or odd choice and more of a depends on what you hold situation. For most NRIs transferring an existing equity portfolio from resident account, the NRO Demat is the practical first step because those shares were originally bought as a resident, therefore they are non-repatriable. Alright, now the actual process, step by step. Step 1. Open your NRO or NRE Demat account. Major brokers like Zero, the HDFC Security, ICICI Direct and Kotak Securities allow NRIs to open these accounts. You will have to complete the KYC with your current NRI residential status. Documents typically required are your Indian PAN card, passport copy, OCR PIO card and a cancelled check from your new NRO or NRE bank account. Step 2. Link your NRO bank account. Before you can transfer any securities, your new Demat needs to be linked to the corresponding NRO bank account. Your broker handles most of this, but you will need to submit an account modification form to update the bank linkage on record. Step 3. Transfer your securities. Once your new NRO Demat is open and bank linked, your securities from the old resident Demat account gets transferred into the new one. This one happens through your depository, either NSDL or CDSL, using an off-market process. Your broker walks you through the entire paperwork, which typically includes a delivery instruction slip, also called as DIS. Step 4. Close your old resident account. Once everything has moved across successfully, you will need to shut down the old resident Demat. At that point, you are fully compliant. And if this video is already helping you avoid a mistake most NRIs don't even realize they are actually making, do me a small favor. Hit the like button and subscribe, and it tells me you want more content like this. Now, I know the process sounds detailed, but honestly, once you have gathered your documents and opened the NRO account, the securities transfer is mostly handled between the depositories. Few weeks of paperwork, not months of headache. Now let's get to the part I teased you at the start. The loophole. Some of you might be thinking, Nikhil, this whole thing sounds complicated. Is there a simpler workaround? There is. And it's completely legal. You can gift your securities to your relative in India, but here's the catch. Almost nobody uses it correctly. So pay attention to the next 60 seconds because one wrong move here turns a clean tax-free transfer into a tax mess. Under Indian tax laws, gift between specified relatives don't attract any gift tax. So if you transfer your shares to a qualified relative, it's treated as a gift transaction, not a sale. No capital gains tax is triggered at the time of transfer. Here's how it actually plays out in real life. Let's say you have been holding 10 lakhs worth of Infosys and Reliance shares in your old Demat account. You do an off-market transfer of those shares to your mother's Demat account in India. Your mother now holds those shares. If she wants, she can sell them in the open market and transfer the cash proceeds to you, or she can hold them as her own investments. In this case, the tax liability shifts to the recipient, your relative, when they eventually sell. They'll pay the capital gains tax on the appreciation from the original acquisition cost, which is inherited from you as the previous holder. Of course, please ascertain the implications of gift in your home country so that it's not adverse. But here's where I have to be precise, because this is exactly where most people make a mistake. The Income Tax Act has a very specific definition of relative, and it's narrower than people presume. It includes your spouse, your brothers, your sisters, the brothers and sisters of your spouse, the brothers and sisters of either of your parents, any lineal ascendants or descendants, meaning your parents, grandparents, children, grandchildren, and the spouses of these people. Notice what's not on that list. Cousins don't qualify, aunts and uncles in that casual sense don't qualify, friends, business partners, distant relatives, none of them qualify. Get it wrong and it becomes a tax problem instantly. And here's the part nobody talks about. because this is technically a cross-border transaction under FEMA. Gifts of Indian securities by an NRI to a resident relative are permitted under RBI's general permission rule. So here's the honest take. Used correctly, this works beautifully. Used incorrectly, it creates a mess. A lot of NRIs use this method to skip the full DMAT conversion entirely, but only when they get the definition right. Alright, option 3, and I'll be straightforward about it when it makes sense and when it absolutely doesn't. If you're planning to return to India in the near future, say within 1 or 2 years, and you genuinely intend to re-establish Indian residency, you can leave your existing portfolio in the resident DMAT untouched. No new transactions, no new buying, no selling, just hold. The moment you return to India and become a resident again, you can simply reactivate your resident DMAT account and continue investing as a resident. The DMAT account reverts back to the full compliance automatically with your change in residential status. This is legal option, but it comes with one specific condition. You cannot trade in that account while you are a non-resident. No new purchase, no redemptions, no SIP contributions through that account. If you transact in a resident account while being an NRI, you are violating FEMA, and that comes with real legal risk. So if your portfolio is sitting passively, you're not touching it, and you're returning to India soon, option 3 is low risk and low effort. But if there's even a slightest chance your time abroad extends, or you ever want to access those funds while abroad, option 1 or 2 are the right move. Now, let me give you the simple rule so this sticks. If you're staying abroad, convert. If you want an easy exit, gift. If you're coming back soon, hold. That's it. 3 paths. Pick one that fits your situation. Now, back to where we started. Remember that 5, 7 or 10 years window I mentioned at the beginning? Let me show you exactly how the consequences eventually catch up, because they always do. The problem surfaces at 3 specific trigger points. Trigger 1, the moment you try to move money abroad, your bank will ask for documentation. They will want to know which account the money originated from, the tax paid on the gains, and your residential status at the time of those transactions. If you were an NRI operating a resident account, that's an instant compliance red flag. I've seen cases where someone operated a resident account for 7 years with no issues and then suddenly couldn't transfer funds abroad for months because of compliance gaps that surfaced only at the repatriation stage. Trigger 2, when tax authorities look at your PAN. Indian tax authorities can track every transaction linked to your PAN. If they see significant market activity without proper NRI account reporting, especially when you're claiming DTAA benefits, it raises red flags and invites scrutiny. Trigger 3, when you apply for a bank loan. Banks run a detailed KYC and background checks during home loans or any large financial product application. If there's a mismatch between your declared residential status and the type of account you've been operating, that's a red flag. It can lead to delays, additional scrutiny, repeated documentation requests, and in some cases, even outright rejection of your application. So here's the truth, nothing goes wrong until it matters most. And by then, fixing it becomes painful. The longer you wait, the more transactions build up and the messier it becomes to clean up. Sorting it out early when things are simple is always far easier than cleaning it after years of accumulated activity. Alright, let's all put this together into action plan. If you became an NRI recently and have an existing portfolio in India, open an NRO Demat account and link NRO bank account. Complete your NRI KYC, get your non-PIS account in place, and initiate the off-market securities transfer from your old resident DMAT account to your new NRO DMAT. Once everything is transferred, close the old account. If you want a simpler route and have a qualifying relative, consider gifting your securities to them. No capital gains tax at the time of transfer, no complex conversion paperwork, just remember the precise definition of relative is covered. And if you're returning to India in the next 1 to 2 years, leave the portfolio untouched, return to India, re-establish residency, and continue normally. And one final thing, whether you choose option 1, 2, or 3, please document everything. Keep records of your KYC submissions, account modification forms, security transfer slips, and the date of each step. In a regulatory system as document heavy as India's, your paper trail is your best protection. So look, when I said at the start that thousands of NRIs are silently violating FEMA every single day, I wasn't trying to scare you. I was trying to wake you up. Because the system isn't designed to catch you immediately, it's actually designed to catch you when it matters most. When you're trying to bring your hard-earned money back home, or buy that house, or close that big chapter of your NRI life. Fix this now when it's a 30-day paperwork problem, not later when it becomes a 30-month compliance nightmare. Because at the end of the day, this isn't about rules, it comes down to one simple question. Can you access your money when you actually need it most? If you found this useful, share it with an NRI friend who's still sitting on a resident Demat account and isn't sure what to do. They'll thank you for it. Subscribe if you haven't already and drop your questions in the comments. Whether it's about the transfer process, which broker to use, Demat setup, and how to handle capital gains on old holdings, I'll address them all for you. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky with Finicky. Thank you for watching, and I'll see you in the next one.